In prior videos and in my blog, I've discussed why I have started to increase my allocation to dividend-paying stocks and stock funds. I will link some of those videos in the More section below. The pace last week, as discussed in my most recent post, was about a $2,600 increase in that allocation. Most of the stocks that I bought were real estate investment trust or electric utility stocks. I previously mentioned one income generation strategy that consists of increasing my allocation to closed-end investment funds in my Fidelity account that pay monthly dividends at least until I go over $200 per month. I've now done that effective for March of 2024. I'm going to continue buying some of those CEFs until I hit $250 to $300 per month from positions. The reason is that I will occasionally pair CEF positions where I sell my highest cost lot profitably, as I recently did for AIO, and then I will increase my dividend yield and as I lower my average cost per share. I also own these securities and other taxable accounts and Roth IRA accounts with lower dollar allocations. Most of the CEFs that I own that pay monthly dividends use leverage that adds both downside risk and upside potential depending on the price movements of owned securities and the cost of leverage, which has gone up for those CEFs that borrow at spreads to short-term rates. That increase in borrowing costs started when the Fed increased its federal funds rate from 0 to 5.25 to 5.5%, which is the current range. Among the stock and balanced CEFs that I own in that account are AIO, AOD, BSTZ, GDV, LGI, JRI, MEGI, and THQ. There are more. A balanced CEF owns common stocks and other securities that might include bonds, preferred stocks, and convertible securities. Of those CEFs, the one that's most interesting to me is BSTZ, that owns equity positions in private companies that normally would not be available to an individual investor. They would be available to hedge funds and institutional buyers. I will link a prior discussion of that CEF in the More section below. Among the bond and senior loan CEFs that are all leveraged that I own are BHK, ERC, JQC, MIN, and WIW. Links to prior discussions of all those previously mentioned CEFs can be found in my blog. The reason for shifting more assets into dividend-paying stocks and stock funds is the likely decline in short-term interest rates. I am extremely overweighted in Treasury bills, short-term CDs, and corporate bonds maturing within 2 years. The primary reason for that overweighting in those short-term maturities is that's where I get the most interest. While I am content to earn over 5% by buying short-term Treasury bills, which I'm continuing to do, I have to recognize the probability now that short-term rates may start to decline this year as the Fed cuts the federal funds rate. As each cut is made, there will be a decline in short-term rates in tandem. The timing of those cuts and the percentage decline from the current 5.25 to 5.5% federal funds range is still speculative in my opinion, though the market is predicting several cuts, starting with the more probable than not 25 basis point cut in June or July of this year and continuing well into 2025. According to the CME FedWatch tool, which is something that you need to have linked and to consult daily, in my opinion, and that uses the federal funds futures contracts. The 6 and 1 year Treasury bill investment rates and the 2-year Treasury note yield are signaling fewer cuts than the federal funds futures contracts, and with the first cut occurring later than the current prediction in the federal funds futures contracts. 2 economic reports released last week suggest that it is premature to cut the federal funds rate. The first was the third estimate for fourth quarter real GDP, which was 3.4%, with the consumer spending remaining robust. The second was the core PCE inflation number for February released yesterday, which was up 0.3% month to month and up 2.8% over the past 12 months. Over the past 3 months, PCE inflation has remained sticky, with the month-to-month increases being of some concern to me. Given the strength of the economy, which has not been recognized by a single Trump supporter that I can find, and the recent stickiness of core PCE inflation at around 2.8%, it would be prudent for the Fed to remain on hold until inflation resumes a downtrend or the economy weakens materially, with inflation remaining near current levels. So if I had to go with a forecast for rate cuts, I would use the current signal sent by the Treasury bill yields, which is that there will be no more than 125 basis point cut before year-end 2024 and no earlier than at the September meeting. That can change with the weakening of PCE inflation, resuming a downtrend no matter how small, with a majority of Fed members signaling, however, a 75 basis point cut by year end. A cut of only 0.25% would not be well received by the stock jocks. I would call what I'm starting to do as consistent with only one 25 basis point cut this year. I will need to substantially accelerate the shift in the dividend-paying stocks and funds when and if 3 cuts this year look likely, not based on the Fed members' prediction contained in their quarterly projections, with the last one made in March, but what is actually happening in the inflation and other economic numbers.